guys, it's Carter. Welcome back to the channel. Now in today's video, I wanted to jump on and talk about what is going on with the banking sector. Now in the past week, we've seen a sell-off of 9.4% in the banking sector. Now in the past day alone, 2% sell-off. So obviously there is so much stuff going on with all these stocks. So we're gonna be breaking down what is going on and is your money safe. So I hope you guys will enjoy it. If you have any questions, let me know down in the comments. So let's jump into it. All right, so like I mentioned, in the past week, we've seen a sell-off of about 9.4% on average among all banking and financial companies. Now, the reason why is because we've seen a collapse of two very, very popular and large banking companies. We've seen the sell-off and collapse of Signature Bank, and we've seen the sell-off of Silicon Valley Bank. Now, Silicon Valley is the second largest collapse in US history. So obviously this is billions upon billions of dollars that are pretty much done for. Now, why does this happen and how does this happen? So in simple terms, when you guys have a bank, often they will offer interest on your money. So if that's just say you give them $100, they may give you $4, $5 over the course of a year for banking with them. It's a little incentive for, their customers. But imagine if you had hundreds of thousands of dollars and you wanted to withdraw it. Obviously, they're using your money and they're investing it into bonds, into credit cards, real estate, and offering other products for other members, and they're getting more money from that. But the issue is if everybody tries to withdraw, they don't have as much money. So this causes a major conflict in the bank because people have their right to get their money back. But obviously, anytime you have this upon billions of dollars, it is not good for the company. So what happened was the FDIC came in and is taking control of the situation. So for everybody that has under $250,000, your money's safe. It's all FDIC insured, but for all other people that have over $250,000 in the bank, it's not looking good. So pretty much how it works is if you have over 250 grand, the FDIC is gonna slowly start to liquidate and sell some of their assets and eventually, hopefully, possibly pay you back. Now, you're not insured, but it's always a good sign when you see the FDIC in there because they will try their best to give you your money back. So why are we getting sell-off among other banking and financial companies? It's actually very simple. We're just seeing people worried. We're seeing people stressed out. We're seeing emotion in the marketplace. And a lot of people think if it's happening here, it's happening somewhere else. And obviously, is it gonna be like the Great Depression? No, it's not gonna be that bad. I think we all learned our lessons during that time, but this still could cause a lot of conflict with other banks if people get worried and they want to withdraw their money. So in simple terms, a lot of stocks are selling off just because the people are nervous among these other companies and there's just a lot of hesitation and emotion in the marketplace. Now, what does this mean for you? If you have a bank, what does this mean? Well, if you have under $250,000, you're safe. You're FDIC insured. Just make sure you're FDIC insured. Go on Google and look up blah, blah, blah bank. Is Chase Bank FDIC insured? And you will see yes or no. Most banks are, so you should be fine. But the issue is if you're not, I would highly recommend switching your banks. Now, a bank that's not FDIC insured is actually one of the most popular banks in the United States. It's Venmo. Now, the only way Venmo is FDIC insured is if you have direct deposit set up with them. Meaning, if somebody sends you $2,000 for a trip and Venmo goes under, that money is gone. So I would highly recommend making sure all banks and institutions are FDIC insured because it will save you guys a ton of money. But in simple terms, we're just seeing a lot of emotion right now. And if you have a bank, I would highly recommend looking towards credit unions because credit unions are non-profit banks, meaning they have no incentive for, offering things that they cannot pay back. It's way less risky and it's a little more personal. You can drive up to local credit unions and see what the best rates are, and you can have a very strong relationship with your bank. Comparing it to like a Chase Bank or an Ally Bank, it's very unlikely that you guys can do that. But guys, I hope you guys enjoyed it. That's what's going on in the banking sector. So hope you guys enjoyed it. Remember to stay happy, guys, stay positive, and stay safe. Take care, everyone.